In the insurance world, the premium that you pay, right? If you're gonna buy car insurance from Geico, they're gonna base that premium on things like the car that you have, right? That's the underlining, basically, like the SPY here. They're going to base it on how long that policy is going to be. Is it going to be 6 months or a year, right? That's the time. They're going to base it on your driving history, how many speeding tickets, DUIs, accidents, right? That's your implied volatility. If this option expired right now, literally right now, it would not be worthless. Most options or all options that expire out of the money are worthless. There's no value to them at all. But if something expires in the money, it still has some value. I want to talk about strike price, expiration date, premium, in the money, and out of the money. And let's start by talking about the strike prices, just to kind of break it down more. So, on an option chain, on a traditional option chain, the strike prices are down the middle, this vertical area here. And you'll see this on Thinkorswim, you'll see it on Interactive Brokers, you'll see it on E-Trade. These are the strikes. Okay? And these strikes are set by the exchanges, like the New York Stock Exchange or the Nasdaq Stock Exchange, the CME. They set these strikes, and they are the ones that will add to these strikes. They will not change these strikes within this expiration period, meaning that if they already have them, they're not going to remove them. I should say they can add to them and put half prices. Weird. Sometimes you'll see weird type of strikes. The exchange can do that. Now, the strike is very, very important because it kind of indicates which direction the option is going. So, as I guess I should say that on an option chain, you want to know which direction the strikes are going first before you kind of break down the individual strikes. So, for example, here on an option chain, a traditional option chain, going up on the screen is normally going down. Okay, so you have the 563 here, the 562, the 561, and then so forth. This is going down on an option chain. And then it's the opposite going up. So going up is going down on your screen. So you got the 564, the 565, the 566, and so forth. This is actually going up. So you want to know the direction of how the strikes are going on the option chain. And then once you understand the strike is kind of the foundation of the option to some degree, because the strike price is where you will know if you're in the money or out of the money, what we're going to talk about here in a second. It's going to let you know if you're most likely going to have some type of assignment or exercise. It's and the strike price is going to indicate to you where you're at all times on the trade based on where the at the money line is at. So also the strike price is where you know where your right or your obligation's at. You do not have a right or an obligation anywhere else on the option chain besides the strike that you have a position at. So for example here, if I bought this option, this put here, I would have the right to sell it at 558. I do not have the right to sell it at 565. I do not have a right to sell it at 550. I only have the right to sell it at this strike price, this 558. And I can do that only within the time frame of the expiration. So this is important to understand, you guys. Options all have expirations. It can expire today, tomorrow, or years from now. And whatever happens has to happen within this time frame, not a second before or not a second after, within this 46 days time frame. So if it goes to 47 days, I no longer have a right here anymore. If it's 46 days and it's still 5 seconds left before expiration, I still have a right to buy or to buy this put. Excuse me, to sell this put. I still have a right to sell this put or sell the shares at the 58 strike. Before we continue with the video, I just want to quickly point out, if you need any additional help, please consider joining our trading club. You can do that by clicking on the link in the description area, and you'll get a 3-month trial for a flat fee of $60. We look forward to seeing you in the trading club. Back to the video. Now, when you're buying at a strike price, it's always going to be a cost, a premium amount that you have to pay for any option. And in this case, we are paying this premium here. I just say for easy math, $13 or $1,300. Okay? That's how much we have to pay for this option at the 558 strike that's expiring in 46 days. This strike is currently out of the money. So when you're looking at these out of the money things, you always have to know where the at the money line is, which is this orange horizontal line going across this TastyTrade platform here. As you guys know, here at Dorian Trader, we call this the baseline, the equilibrium, because everything is going towards it or away from it. And so the at the money line is always where the stock is currently trading. This is where the SPY is trading at. So it's in this area. And once you know that the at the money line, then you should be able to easily determine where is in the money and out of the money areas are at. So in this case, on the call side, below the at the money is the out of the money area on the call side. And then to this put side, as I mentioned, this put that we're buying is out of the money. So this is the out of the money area here. So this strike right now is out of the money, and we have the right to sell at this 558. So we most likely wouldn't exercise our right when this is out of the money. We would almost 100% of the time, if we're going to exercise our right to sell this strike is going to be in the money. And right now, the in the money area on the put side is right here. And the in the money area on the call side is right here. So it's always kind of the opposite. When you have a right, and that's when you're the buyer of an option, right? If you're the buyer of the put, you have a right to sell. If you're the buyer of the option, you have the right to purchase. You buy the call, you have the right to purchase. You're going to exercise your right most of the time, almost 100% of the time, when it is in the money. And when you have an obligation, right? If you have an obligation, if you're the seller of the put, you have an obligation to purchase. If you're the seller of the call, you have the obligation to sell the shares, right? The seller of the put has the obligation to buy the shares. The seller of the call has the obligation to sell the shares. If you have an obligation, you're most likely going to have to live up to that obligation if it's in the money. So almost 100% of the time, it's not 100%, but almost 100% of the time, you don't have to worry about your obligation unless it's in the money. So it's important to understand where you're at on the option chain regarding being at the money, in the money, or out of the money for a number of reasons. But for right now, because of your right and your obligation. You're normally going to exercise that right when it's in the money, or you're normally going to have to live up to that obligation when it's in the money. Now, what is in the money? And what is out of the money? So let's go over here and let's look at the same strike. And let's put this strike at the 558. Okay. And I just say this is trading at 564. Just for easy math for us, everyone. So if it's trading at 564 and your strike is at 558, and this is the call side, so you have the right to purchase when you buy at a strike price on the call side. You have the right to purchase. So in this example, this is in the money because it is $6 below where it's currently trading at on the call side. So what this is called right here, this $6 difference, this is what is called intrinsic value or tangible value. If this option expired right now, literally right now, it would not be worthless. Most options or all options that expire out of the money are worthless. There's no value to them at all. But if something expires in the money, it still has some value. In this case, it would have $6 in value. Doesn't mean you win. You could still lose on the trade. So for example, if we bought this option right now for, let's say, $21, that's $2,100 we have to pay. And if it expired and it was and the stock was trading at 564 and it expired, well, we still, it would only be worth $600, and we paid $2,100, so we'd be down $1,500. We would still lost $1,500, but it won't be worthless. We wouldn't have lost all of the $1,500. So this is what is called intrinsic value. It has tangible value. When something is out of the money, let's go back to this put here. This value right here, it's $6 out of the money, using that 568 again. But it's going for almost 13. Let's just say 13. It's going for 12 something, high 12s, but let's just say 13. All of that, all of that 13 is what is called extrinsic value. Extrinsic value or time value. It's all based on time. It's no real tangible value. It's all time value. So this, if it stayed this way, this would go to zero. Literally, this option price would go from 13, now 12 something, to zero if it stayed out of the money, which right now it is $6 out of the money. So you have intrinsic value, which has tangible value, and you have extrinsic value, which is time value only. So intrinsic, when something is in the money over here, it can have time value and tangible value. So in this example, we know it has at least $6 of tangible value, but it's going for over 21. So it's got like $15 of extrinsic or time value in it as well. But once it gets to expiration, it's only going to have tangible or intrinsic value. When something's in the money, it can have time value and intrinsic value. When it's out of the money, once again over here on this put side, it only has time value. It has no extrinsic value. All right, so the premium for these options are based on how much time is left and the implied volatility of the option. Okay? And it's based on the price of the underlying. So for example, you guys, we normally use the insurance company example for how we trade options. In the insurance world, the premium that you pay, right? If you're gonna buy car insurance from Geico, they're gonna base that premium on things like the car that you have, right? That's the underlining, basically, like the SPY here. They're going to base it on how long that policy is going to be. Is it going to be 6 months or a year, right? That's the time. They're going to base it on your driving history, how many speeding tickets, DUIs, accidents, right? That's your implied volatility, right? How volatile are you? How much risk do they see in you as a driver? And they're going to go by your age and your zip code and things like that. When you are the option, when you're trading options in the open market, you have those same type of factors. Right? You have time, you have the underlining, you have implied volatility. All of that is going to be factored into the price. And sometimes that price can be pretty substantial, even though it is out of the money. It has no tangible value. But always, regardless of how volatile a stock is, if something expires out of the money, it's going to be worthless, not worth not even a cent. But if something expires in the money, it's going to be worth something. It's not going to be worthless. It can feel that way because you lost a lot of the value of the stock, but if it expires in the money, it's not going to be worthless. All right, so this is what I wanted to talk about this morning regarding the basics of the strike price, the expiration date, the premium, in the money and out of the money.